All right, let's jump right into this. Welcome to our deep dive into the ultimate survival guide for the modern Indian corporate arena. Today, we're putting on our Harvard Business School strategy hats, looking through the lens of an elite Silicon Valley VC and decoding Clayton Christensen's legendary framework, the Innovator's Dilemma. We're going to break down exactly why massive, incredibly successful companies fail, and more importantly, how you can architect a total corporate turnaround.
I want you to really think about this for a second. Imagine a multi-billion-dollar monopoly. They've got the smartest, highest-paid managers, a literally endless R&D budget, millions of fiercely loyal customers, and they crush their quarterly targets every single time. Can a company like that still go bankrupt? Now, traditional business logic screams, no way, absolutely not. But the answer completely defies everything taught in standard business schools. Yes, they can, and honestly, they frequently do.
And that brings us to what we call the good management paradox. Christensen's research proves something mind-blowing. The world's most successful companies often crash exactly when their management is operating flawlessly. The mistake isn't that the executives are incompetent. The mistake is that they are perfectly executing the exact rules that are supposed to guarantee success. But in the face of market disruption, following those rules is essentially a corporate suicide note.
So, here's our battle plan for this explainer. We'll reverse engineer that management paradox, map out the innovation matrix, do a clinical autopsy on some fallen monopolies, unpack the 5 disruption principles, and finally, build a tactical modern India playbook.
Okay, Section 1, the good management paradox. Let's reverse engineer the root cause of corporate failure.
What's truly ironic here is that standard operational best practices, listening to your best clients, pouring money into high-margin products, and ignoring tiny, unproven markets, these are exactly what will eventually kill your business. Now, in a stable environment, this is textbook perfect strategy. But when a world-changing, disruptive technology hits the scene, playing by these exact rules completely blinds you to the threat until it is way too late.
To really grasp how a market can flip overnight, we need to hit Section 2 and map out the core matrix of innovation. The crucial takeaway is this stark contrast between sustaining and disruptive innovation. Sustaining innovation just makes good products better. Think upgrading from last year's smartphone to this year's model. It's high margin, it's complex, and your existing top-tier clients want it. Mega corporations will always win this sustaining arms race because they have endless resources. But on the flip side, disruptive innovation starts out cheaper, simpler, smaller, and frankly, kind of worse in performance. Current top clients couldn't care less about it. But lean, agile garage startups dominate this disruptive side because they target entirely new, low-end, unserved markets. Let's trace how this stealth invasion happens along the S-curve. Step 1. The disruptive tech launches, and the big incumbents' customers brush it off as a cheap toy. Step 2. The startup pivots to a niche, low-end market. Step 3. Stealthily, that startup rapidly improves its tech along an S-curve. Then we hit Step 4, the overshooting point. This is where the big company makes its product so overly complex and expensive that normal customers just don't need all those features anymore. And finally, Step 5. The startup's tech becomes good enough for the mainstream, customers migrate en masse to the cheaper option, and the incumbent's market share just evaporates. The collapse is almost instant.
All right, let's ground this theory in some raw data with Section 3, Autopsy of Fallen Monopolies. Let's look at the actual bodies left behind by market disruption.
Take a look at the brutally competitive disk drive industry. We went from 14-inch mainframes in the 70s to 8-inch drives, then 5.25-inch desktops, and down to 3.5-inch laptops. Every single time that drive size shrank, market leaders totally ignored the new tech because their best clients weren't asking for it. And what happened? Massive, cascading bankruptcies across the board.
And listen, this dynamic isn't just a Silicon Valley tech thing. It happens in heavy industry too. Look at mechanical excavators. Bucyrus was the absolute king of massive cable-operated excavators. When hydraulic technology first emerged, the buckets were tiny and super weak. Bucyrus's mainstream construction clients literally laughed at them. So hydraulics found a tiny, boring niche, residential trench digging. But as hydraulic power scaled up that S-curve, they eventually drove mainstream cable giants like Bucyrus to total extinction.
Which brings us to Section 4, the 5 disruption principles. Why do elite managers consistently let this happen? Let's unpack the structural constraints.
It all boils down to this core economic model, the resource allocation process, or RAP.
The fundamental Harvard Business School truth you need to remember is that your company's strategy is not what the CEO says in a fancy press release, it's exactly where the finance team signs the checks. And RAP is a financial system that systematically assassinates disruptive, low-margin ideas internally, simply because they can't meet the high historical return on investment targets that the board demands.
There are 5 structural principles driving this inertia. First, you're relying on investors who demand high margins. Second, small markets just don't solve your massive growth needs. Third, you literally can't run a spreadsheet ROI analysis on a market that doesn't even exist yet. Fourth, your legacy resources, processes, and values, they're optimized for large-scale operations, not micro-wins. And finally, technology usually overshoots actual market demand. These constraints perfectly explain why tight-fisted Indian boardrooms constantly reject agile experimentation in favor of heavy spreadsheets, killing innovation right at the root.
Just think about the math for a second. If you're a 10,000 crore giant looking for a standard 10% annual growth, you need to find 1,000 crores in new revenue. A brand new disruptive market might only be worth 10 crores right now. To the giant, that looks completely meaningless, so they ignore it. But that is exactly why startups get an absolute, unchallenged monopoly in the early days. By the time that market grows to 500 crores and the giant finally wakes up, the startup has already won the game.
Okay, autopsy complete. Let's pivot to tactical execution and the cure in Section 5, the Modern India Playbook.
So, let's break down these 4 turnaround strategies and apply them directly to the hyper-competitive tech ecosystems of Bengaluru and the massive corporate structures of Mumbai. Whether you're running a fast-paced agency, a tech firm, or a traditional manufacturing powerhouse, this is your blueprint.
Step 1. Target the unserved. You have to identify the lower-end market that your premium competitors are totally ignoring. Launch an ultra-lean or low-cost product vertical specifically designed for price-sensitive non-consumers who are currently priced out of traditional services. You need to capture them with standardized, low-cost workflows before a nimble startup beats you to it. Step 2. To actually survive those low initial margins of a disruptive product, you need what we're calling the 5% GST principle. This means ruthlessly automating your back end. We're talking invoicing, customer billing, tax compliance algorithms. You have to drop human administrative friction to near zero. You absolutely cannot apply your legacy corporate overhead costs to a lean startup initiative. Automate it so your unit economics actually makes sense at that super low price point. Step 3. Build a skunkworks. Do not, I repeat, do not try to innovate from within your legacy sales and finance teams. They will crush the idea to protect their current margins. Create an autonomous 3-member digital squad. Literally put them in a different building. Keep them entirely removed from the daily firefighting of the main business and give them one single KPI. Disrupt the main business. Just like when IBM launched their PC division in a totally separate facility in Florida, isolating your innovation squad from legacy corporate processes is the only way you're going to build a future.
Ultimately, Christensen's core lesson is a tough pill to swallow. Massive success is often the very seed of future destruction. So I'll leave you with this one question. Are you disrupting your own business today, or are you just sitting around waiting for a garage startup to do it tomorrow? Take these frameworks, leave your corporate ego at the door, stop underestimating low-margin simplicity, and start disrupting yourself before the market does it for you.